Do you own an annuity and find yourself considering a change? Whether you're thinking about cashing out or moving your money to a different investment, there are two critical factors you need to understand. First, surrender fees, and second, what are your tax implications? These factors could significantly impact your financial outcome, and today I'll walk you through exactly what you need to know. I'm Danny Gudorf, owner of Gudorf Financial Group, and I've helped many clients navigate this decision successfully. In this video, I'll break down how to surrender an annuity, how the surrender fees work, and what tax consequences you might face, and how to evaluate if surrendering your annuity is the right move for your retirement. Let's get started with what you need to know. Understanding the implications of surrendering annuity is crucial for investors who are considering either cashing it out or transferring it to another financial vehicle. The decision-making process involves careful consideration of two primary factors. The first, the potential surrender fees imposed by the insurance company, and then the tax implications that could arise from that transaction. I frequently encounter situations where clients come to us seeking guidance about annuities they purchased years ago, often questioning whether these financial products truly align with their investment goals in retirement. The reality of annuity sales is that in the financial industry, it presents some concerning patterns. Many clients find themselves in situations where they were sold annuities by brokers who earned a substantial commission without properly considering what the product was and what was the optimal choice for their specific situation. This misalignment between the client's needs and the product features often leads to discussions about potentially surrendering the annuity several years after the initial purchase. However, before making such a significant financial decision, it's important to conduct a thorough analysis of both the surrender fees and the potential tax consequences that could arise and how this will affect your overall retirement outcome. Let's dive deeper into the structure and implications of surrender fees, which represent one of the most significant considerations when evaluating your annuity. Insurance companies typically implement surrender fee schedules that specify a predetermined amount and period during which withdrawing funds or surrendering the annuity will result in surrender fees. These schedules are often designed with a decreasing percentage structure, meaning the surrender fees gradually diminish over time. For instance, a common 7-year surrender schedule might start with an 8% penalty in the first year, decreasing to 7% in the second year and 6% in the third year, and continuing this downward path until the surrender period expires. The variation in surrender fee schedules across different insurance companies and products adds another layer of complexity to this decision. While some annuities come with a 5-year surrender period, others might extend to even 7 or 8 or even more years. The specific terms and the conditions of these surrender schedules are most often detailed in your annuity contract, making it essential for investors to carefully review their policy documents or consult with the insurance company or the agent that sold them this policy. To illustrate the potential impact of surrender fees, consider a scenario where an investor places $100,000 in a non-qualified annuity with a 7-year surrender schedule. If this investor were to decide to surrender the policy in year 2, when the surrender fees were 7%, they would incur a $7,000 penalty before assessing their original account balance. Despite the negative effect of surrender fees, there are circumstances where paying these penalties might actually serve the investor's best interest in the long run. Consider a situation where an investor held a non-qualified annuity for 6 years and faces a 3% surrender fee remaining. If waiting the additional time to avoid the surrender fee means missing out on potentially higher returns from an alternative investment, paying the 3% penalty might make financial sense. However, this analysis becomes significantly more challenging when dealing with larger surrender fees in the early part of the contract. In these cases, a comprehensive cost-benefit analysis is essential to determine whether immediate surrender or delayed action better serves your financial goals. The tax implications of surrendering an annuity represent the second critical aspect of this analysis. And these considerations can vary significantly depending on whether the annuity is qualified or non-qualified. For the purposes of this discussion, let's focus on non-qualified annuities, which are purchased with after-tax dollars and have grown tax-deferred, one of the main benefits of an annuity. In this scenario, if you initially invested $100,000 and the current cash surrender value has grown to $110,000, there is a $10,000 gain that would be subject to ordinary income tax rates upon surrender. This tax treatment applies regardless of how long the investor has owned the annuity, which differs significantly from the preferential tax treatment that long-term capital gains exist for stocks that are held for longer than 12 months. It's worth noting, though, that if the cash surrender value falls below the initial investment amount, no tax liability would be incurred since no gains were realized. To accurately assess the potential tax implications of surrendering an annuity, we strongly recommend that investors contact their insurance company directly to obtain 3 pieces of crucial information. First, the cost basis of the policy. Second, the current cash surrender value. And third, the potential taxable gain that would result from a surrender. This information can typically be obtained directly from the insurance company without requiring any involvement from the original selling advisor or insurance agent. For clients facing potential tax liability from surrendering non-qualified annuities, there are several approaches that can help optimize the timing and the structure of the annuity. For those approaching retirement, one effective strategy involves delaying the surrender until retirement income levels are lower. For example, if surrendering an annuity would generate a $15,000 taxable gain, waiting until retirement when your overall income is lower could result in a more favorable tax treatment. If you're currently employed, individuals coordinating the annuity surrender with increased contributions to your 401k accounts can help offset some of the tax impact. If an employee has the capability to increase their 401k contributions by $15,000 through salary deferrals, this could effectively neutralize the tax liability that was generated from the annuity surrender. The complexity of surrender decisions extends just beyond fees and taxes, encompassing various personal and financial factors that must be carefully evaluated. The magnitude of surrender fees and the potential tax liabilities plays a significant role in determining the optimal approach. But these considerations must be balanced against the potential benefits of alternative investments. This evaluation process should include a detailed analysis of the new proposed investment strategy, including its potential returns, risk profile, and the alignment with your overall retirement goals. Timing considerations also play a crucial role in the surrender decision-making process. What is the stock market doing? Where are interest rates at? And what other personal financial circumstances could impact the timing of this decision? Additionally, investors should consider their current and future income needs, tax brackets, and overall retirement plan strategy when determining whether it makes sense to keep their annuity or if they should surrender it. This comprehensive approach helps ensure that the decision aligns with both short-term goals and your long-term goals. Whether the decision involves accepting the surrender fees for potential better investment opportunities or implementing a tax-efficient surrender strategy, the key lies in conducting a thorough analysis and considering all relevant factors before taking action. Throughout my time working with clients, I've come across a lot of different annuities and financial situations. Now, at our firm, we don't believe annuities are good and we don't believe annuities are bad. An annuity is just an investment vehicle. It's a vehicle that a client has available to them. A lot of times clients come to us asking for advice. What should I do with my annuity? Should I get rid of it? Should I keep it? Is it good for me? Is it right for my financial plan? Well, those answers involve discussing what is the client's current goals and what is their risk capacity. That is what's actually going to determine whether an annuity is good for them or bad for them. If you found this information on annuity surrenders to be valuable, you'll definitely want to stay informed about another important retirement planning topic that catches many clients off guard. Did you know that even making one small mistake with your required minimum distributions could result in a 25% penalty from the IRS? Understanding these common pitfalls could help you avoid costly errors when it comes time to start taking distributions from your retirement accounts. Watch this video here where I walk through the top 10 RMD mistakes that I see retirees make every day.